Saturday morning, February 7th, 2026. You check your phone. Silver is up 3%, gold is climbing. And if you're like most people watching precious metals, you assume it's the usual suspects. Geopolitical noise, inflation worries, maybe some Yang commentary that moved the needle. You scroll past it, just another weekend in the metals market. You would be wrong, catastrophically wrong. What you're witnessing isn't a market reaction. It's the opening sequence of a regulatory earthquake that most of the financial world won't understand until it's already destroyed them. In 36 hours, at market open on Monday morning, a rule that's been delayed, diluted, and debated for over a decade finally goes into absolute enforcement. And when it does, it will expose the largest structural fraud in commodity market history. The rule is called the Net Stable Funding Ratio, part of the Basel III banking framework. The institution enforcing it is the Bank for International Settlements, the central bank of central banks, and the institutions about to be obliterated by it. Every major bullion bank that's been running a fractional reserve precious metal scheme for the past 15 years. Here's what changes on Monday. Under the old regulatory regime, banks could hold massive short positions in gold and silver markets, treating paper claims and futures contracts as low-risk assets requiring minimal capital reserves. They could flood the COMEX with synthetic supply, suppress prices through algorithmic manipulation, and never face consequences because the system was built to let them cheat. That ends in 36 hours. The new NSFR classification treats unallocated precious metals as high-volatility illiquid assets requiring 85% cash reserves. If a bank holds $1 billion in paper shorts, they need $850 million in Tier 1 capital sitting idle to justify that position. Meanwhile, allocated physical gold and silver, zero risk weight, zero reserve requirement. The regulatory incentive just inverted overnight. The banks are trapped. They're staring at balance sheets that violate the new framework. And the penalty for non-compliance isn't a fine. It's license revocation. It's being cut off from Federal Reserve liquidity facilities. It's operational death. So they have one option: convert paper to physical before Monday's open. Buy actual metal. Cover the shorts they've been rolling for years. There's just one problem. The metal doesn't exist. Not in the quantities they need. Not even close. Friday afternoon at 2:47 p.m. Eastern, the first crack appeared. Silver spiked from $29.63 to $31.20 in 4 minutes. The financial media called it retail enthusiasm. That's a lie designed to hide what actually happened. Algorithmic short covering by European banks trying to beat the deadline. The trade volume data from SLV, the largest silver ETF, tells the real story. At exactly 2:48 p.m., a block trade of 14 million shares executed. By market close, $63 million in net inflows had poured into a single fund in one session. That's not retail. That's institutional panic. And it's just beginning. Because the math behind this crisis doesn't just suggest a price spike. It guarantees systemic failure. To understand why, we need to go back to where this architecture was built. Back to the moment when fractional reserve banking was quietly extended into the precious metals market, creating the most leveraged house of cards in modern finance. The system that's about to collapse was constructed deliberately, brick by brick, over decades. It started with a simple premise: treat precious metals like currency derivatives, create paper claims far exceeding physical supply, rely on the fact that most holders would never demand delivery. For years, this worked beautifully for the banks. Under Basel II regulations and the transitional Basel III framework that governed until now, unallocated gold and silver were classified as Tier 2 or Tier 3 assets. Low risk, minimal capital requirements. A bank could hold $10 billion in paper shorts while keeping just a fraction in actual reserves. They could issue futures contracts, create synthetic ETFs, run unallocated account schemes, all with the regulatory blessing of treating imaginary supply as real. The mechanism was elegant in its simplicity. When the price of silver threatened to rise, banks would deploy high-frequency trading algorithms to flood the COMEX order book with sell orders. Quote stuffing. Spoofing. Techniques that are technically illegal under Dodd-Frank, but rarely prosecuted because the fines are pocket change compared to the profits. The algorithms created the illusion of unlimited supply, crashed the price in seconds, then vanished before settlement. Rinse and repeat for 15 years. This suppression served multiple purposes. It kept industrial users happy with cheap input costs. It prevented precious metals from competing with bonds and equities for investor capital. And most importantly, it protected the dollar's status as the global reserve currency by ensuring that hard assets never threatened fiat hegemony. But the Bank for International Settlements was watching. And they understood something the commercial banks were too arrogant to see. The fractional reserve precious metals market was creating systemic risk on par with the mortgage-backed securities that nearly destroyed the global economy in 2008. The leverage ratios were insane. The counterparty relationships were impossibly tangled. And the moment anyone demanded mass physical settlement, the entire structure would vaporize. So in 2019, the BIS made a quiet but revolutionary change. They reclassified physical gold as a Tier 1 asset, equivalent to cash, for the first time in modern banking history. It was buried in a footnote of a quarterly report. The mainstream financial press ignored it completely. But central banks paid attention, and they started buying. In 2022, over 1,000 metric tons of gold. In 2023, another 1,037 tons. In 2024 and 2025, the accumulation accelerated. China alone added over 400 tons to official reserves, with actual purchases likely double that when you account for off-balance sheet proxy entities. They were front-running what they knew was coming, the NSFR enforcement, the moment when the regulatory framework would force commercial banks to choose between holding real assets or facing obliteration. If you're starting to see the pattern here, if the pieces are clicking into place, do me a favor and hit that like button. Because what I'm about to show you in the next section is the mathematical proof that this system cannot survive Monday's deadline. The numbers are so extreme that even people who work in finance have trouble believing them, but they're verified, documented, and absolutely undeniable. The NSFR rule that activates Monday morning doesn't just change incentives, it changes the fundamental physics of how these markets operate. And the banks that built fortunes on paper manipulation are about to discover that physics doesn't negotiate. Let me show you the numbers that should terrify anyone who understands how markets function. As of Friday's close, the COMEX held 412,000 open silver futures contracts. Each contract represents 5,000 ounces. That's 2.06 billion ounces of paper claims. Now compare that to annual global mine production, 850 million ounces. The New York Futures Exchange alone has open interest representing 2.4 years of total planetary supply. Here's where it gets obscene. The registered silver in COMEX vaults, the actual physical metal available for delivery, totaled 64 million ounces as of Friday night. Do the division. 2.06 billion paper ounces divided by 64 million physical ounces equals a leverage ratio of 32 to 1. 32 paper claims for every ounce of actual silver. And on Monday morning, the BIS is telling banks they need to back that paper with capital or physical metal. There is not enough silver on Earth to cover even 10% of outstanding claims. This isn't a squeeze. This is a structural impossibility. When Roosevelt confiscated gold in 1933, it was because banks had issued more paper claims than they had metal in vaults. When Nixon closed the gold window in 1971, it was because foreign governments realized the United States had created more dollar claims on gold than Fort Knox actually held. We are watching the same pattern repeat, except this time the leverage is exponentially higher, and the regulatory hammer is falling with precision timing. The banks know they're trapped. They have three theoretical options, all catastrophic. Option 1, liquidate short positions by buying futures contracts at market price. But there isn't enough sell-side liquidity to absorb that buying pressure without sending prices vertical. Option 2, take physical delivery from COMEX vaults. But 64 million ounces against 2 billion in claims is mathematical lunacy. Option 3, raise 850 million in Tier 1 capital for every billion in shorts. But most banks don't have that capital, and if they tried to raise it by selling other assets, they'd expose their insolvency and trigger bank runs. Every move leads to the same outcome. The price goes parabolic. The paper-physical spread explodes. And the fractional reserve bullion banking system collapses into itself. Friday's price action was just the warning tremor. The real shock hits Sunday night when futures markets reopen at 6 p.m. Eastern. That's when European banks, facing Monday's European Central Bank compliance checks, will start covering positions in size. By the time London opens Monday morning, the cascade will be underway. By the time New York opens, we could be looking at silver prices that bear no resemblance to anything seen in the past decade. But here's the variable that could turn this from a crisis into a catastrophe, force majeure. If even one major bullion bank declares they cannot meet delivery obligations due to circumstances beyond their control, the COMEX system doesn't just wobble, it breaks. Futures contracts become unenforceable. Price discovery shifts entirely to physical markets where supply is genuinely scarce. And in a market where holders refuse to sell because they're waiting for higher prices, gaps can run to triple-digit figures in hours, not weeks. This has happened before, just on smaller scales. In 2008, Silver Eagle premiums went from $2 over spot to $8 in weeks. The U.S. Mint suspended production. Dealers sold out for months. The paper price showed $9, while physical traded at $15 to $17. But that was a liquidity crisis in one product category. What's coming Monday is an entire asset class being forced to reconcile a decade of fraud with physical reality. The algorithm that suppressed prices for 15 years only worked because banks had unlimited ability to create synthetic supply. Once the NSFR rule removes that ability by requiring massive capital reserves for every new short position, the suppression mechanism vanishes. And when it vanishes, the price reflects actual supply and demand for the first time this century. And if you think I'm exaggerating the severity, you haven't looked at what's happening in the physical market right now, which brings me to the part they really don't want you to understand. While Western banks were building their paper empire, certain nation-states were making very different calculations. In 2024, China imported over 7,000 metric tons of silver. That's approximately 225 million ounces, representing more than 25% of global annual mine production flowing into a single country in 12 months. This wasn't jewelry demand. This wasn't industrial consumption for domestic manufacturing. This was strategic accumulation into government vaults. The Chinese Communist Party understands what most Western investors have been trained to ignore. Silver isn't just a precious metal. It's a critical industrial commodity essential for solar panels, electric vehicles, 5G infrastructure, and military applications. And they understand that Western banks have been artificially suppressing prices through paper market manipulation for decades. So while the price was kept artificially low, they bought physical in staggering quantities. When the price breaks free and reflects actual scarcity, China will control a dominant share of global supply. Russia has been running the same strategy with gold, India with both metals. The entire BRICS coalition, now expanded to include Saudi Arabia, UAE, Iran, Egypt, and Ethiopia, has been systematically moving reserves out of dollar-denominated assets and into hard commodities. This isn't a random trend. This is coordinated preparation for a monetary system reset. And here's what nobody in mainstream coverage will tell you. The BIS isn't trying to save the current system. They're trying to replace it. They know the dollar-based, debt-driven financial architecture is terminal. They know $35 trillion in U.S. national debt cannot be serviced without currency debasement. They know the derivative markets, with over $1 quadrillion in notional value, represent systemic risk beyond any central bank's ability to contain. So they're using Basel III to quietly force a transition to asset-backed banking. The NSFR rule isn't about protecting against another 2008-style crisis. It's about ensuring that the banks which survive into the next monetary regime are the ones holding physical Tier 1 assets with intrinsic value. It's about making paper claims so expensive to maintain that institutions are forced to abandon fractional reserve practices and return to something resembling honest money. Think about what this means for the global power structure. The Western financial system has been built on the assumption that paper can substitute for physical value indefinitely, that central banks can print currency without consequence because the world will always accept dollars in exchange for real goods. But when the regulatory framework forces banks to back their positions with actual assets, that assumption dies. And the countries that prepared by accumulating gold and silver emerge as the new financial superpowers. This is the great wealth transfer happening in real time, while financial media discusses earnings reports and interest rate speculation. The geopolitical implications are staggering. The nations that accumulated physical during the suppression era will set the terms of the next monetary system. The ones that relied on paper hegemony will be left negotiating from weakness. Now, I need you to think about a question that keeps me awake at night. If the Basel III enforcement is designed to transition away from paper-based fractional reserve banking, what happens to everyone holding dollar-denominated savings bonds and paper assets when that transition accelerates? Is the conventional wisdom about portfolio construction still valid, or are we operating on assumptions that are about to be violently disproven? Drop your analysis in the comments. I read every single one, and some of the sharpest insights on this channel come from this community working through implications together. Because this isn't just about silver prices or banking regulations. This is about the architecture of global power being rewired in real time. And the people who understand what's happening have a narrow window to position themselves accordingly. So here we stand. Saturday night, February 7th, 2026. Less than 36 hours until the regulatory deadline that ends 15 years of fractional reserve precious metals banking. The banks are holding emergency board meetings. The regulators have drawn the line. And the physical market is showing stress fractures that will become chasms by Wednesday. What happens next isn't speculation, it's math. When Sunday night futures markets open at 6 p.m. Eastern, we'll see the first wave of forced short covering. When London opens Monday, European banks will add their compliance-driven buying. By the time New York trading begins, the price will be reflecting something markets haven't had to price in for decades, actual scarcity. The gap between paper price and physical premium will widen to levels that make 2008 look like a minor dislocation. And then comes the critical question, does the system hold or does it break? If the major bullion banks can muddle through by spreading pain across short covering, physical delivery, and emergency capital raises, we see a violent repricing, but the infrastructure survives. If even one declares force majeure, unable to meet delivery obligations, the contagion spreads, counterparty relationships collapse, the futures market loses credibility, And price discovery shifts entirely to physical markets, where supply is genuinely constrained and premiums can run to multiples of the paper price. History suggests the latter is more probable than anyone in official positions will admit. Systems built on decades of fraud don't gently correct. They break. And when the break comes, it happens faster than regulatory responses can contain. But let me be precise about what this means for you. This isn't doomsaying. This is acknowledging that we're at an inflection point where the rules of the game are changing. The financial system that rewarded paper speculation and punished physical holders is being replaced by a framework that does the opposite. The NSFR rule is just the mechanism. The underlying reality is that confidence in purely fiat systems is eroding, and institutions are being forced to demonstrate actual backing for their claims. If you hold physical gold and silver, you're positioned for a world where Tier 1 assets command a premium that paper can't replicate. If you're relying on paper ETFs, futures contracts, or unallocated accounts, you're holding claims that may not be enforceable in a force majeure scenario. If you're entirely in cash or bonds, you're betting that the dollar maintains reserve currency status through a transition that's designed to reduce dependence on dollar hegemony. The crossroads is now, not next month. Not after the crisis becomes undeniable. The accumulation happened during the suppression. The repricing happens during the transition, and the transition begins Monday morning. Here's what I carry from this. Precious metals were never about speculation or portfolio diversification. They were always about what happens when paper claims exceed physical reality by such extreme multiples that reconciliation becomes impossible. We're watching that impossibility become undeniable. The banks that created synthetic supply through algorithms can't algorithm their way out of a regulatory requirement for 85% capital reserves. The fractional reserve model breaks when the fraction goes to zero, and that's where we are. The Basel III NSFR enforcement isn't a random regulatory update. It's the BIS forcing the global banking system to confront 15 years of accumulated fraud. The banks that prepared by holding physical will survive. The ones that relied on paper manipulation will face a choice between insolvency and capitulation. And the price of precious metals will finally reflect what they've always been: finite physical assets in a world of infinite paper claims. The empire isn't collapsing, it's restructuring. And the only question is whether you recognize the blueprint before the new architecture locks into place.